We just got the fourth quarter results from one of the companies that I've been most anticipating seeing the results from in my portfolio, and that is Confluent. And the stock is absolutely crushing it. The stock is up 27%. That is a huge gain. Let's take a look at what Confluent just reported. Talk about the results, talk about going forward, try to answer the question, even with the stock up more than 25% in a single day, whether or not Confluent is a stock worth buying right now. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link. You see it right on the screen. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. You definitely want to check that out. Okay, let's go through Confluent's earnings presentation. The company continues to grow at a really fast pace, and it's getting better economic results. One of the big stories with Confluent, so many of these software as a service, cloud companies has been trying to get to profitability, generating positive cash flows. So many of them went public in the easy money, cheap money times, and really didn't have a clear path to get to profitability. Well, guess what? It looks like Confluent is starting to answer the bell on that one. Let's take a look. So you see fourth quarter results, $213 million in revenue, better than expected, 26% increase. Here's a big one that's important. Confluent Cloud. This is the fastest growing part of the business. As more data is living in the cloud that companies are dealing with, they're moving their data to the cloud. Confluent Cloud, Apache Kafka that's been built for the cloud, is growing even faster, up 46%. This is the first time that we saw Confluent Cloud and its Confluent base product both generate $100 million in revenue. I'm going to predict that we're going to see a quarter in 2024 where Confluent Cloud is going to become the biggest part of the company's business. It's still less than 50%, but it's quickly catching up with its core Confluent product. Operating margin, positive operating margin. Now, this is adjusted. This is their non-GAAP, so they're leaving out some things like stock-based compensation that's really meaningful, but this is a step in the right direction. As they say right here, first quarter that it's ever been positive. Full year results, a couple things that are important to note here. Number one, 33% revenue growth. So we're seeing a deceleration. Fourth quarter revenue growth was slower. Confluent Cloud growth is slowing as well in the high 40s versus 65% for the full year. So a clear path of deceleration there. But even as growth is slowing, still growing at a very high rate, the economic results are getting better as the company gets to a larger scale. Over 5% non-GAAP operating margin positive in the fourth quarter, versus negative 7.4% for the full year. That trend of improvement continues to drive the company towards profitability and positive cash flows. Focusing again on the core of the business, the most important part of revenue is subscription revenue. Total revenue grew 26% in the quarter, but subscription revenue is growing at a 31% clip. Confluent Cloud, 46% growth. Now it's 47% of total revenue. I'm pretty sure we're going to see real soon, it's going to become more than half of revenue and continue to become a more and more part of the mix. Talk about margins a little bit. Subscription gross margins tied to Confluent Cloud and its base Confluent product, 81.8%. That's the highest the company has ever produced. Total gross margin, 77.5%. I think you're going to continue to see subscription gross margin move higher, and it's going to continue to move total gross margin higher as service revenues become a smaller and smaller portion of the mix, and these higher margin subscription revenues continue to grow. Let's talk about operating margin, up 27 basis points year over year, 5.3% in the quarter, first time positive. What we're seeing, why this is happening, is because every incremental revenue dollar that the company brings in at this point, a smaller portion of it has to cover operating expenses. It's the operating leverage that you get at scale with these sorts of businesses where you only need a certain portion of revenue to cover costs, and then you get really, really profitable. So this isn't like a steelmaker that a mass percentage of its revenue has to cover operations. These businesses can be incredibly, incredibly cash efficient, and we're seeing Confluent now make that transition from a money burner to a steady state business, and then it's going to turn into a cash cow. I feel pretty confident in what we're seeing. Let's take a look at some of those key financial metrics again to build on top of it. So again, these are adjusted numbers, but we saw it generate for the fourth quarter 9 cents in adjusted positive net income. Really good positive step. One of the key things to remember with this adjusted metric, it's adjusting out something that's pretty big, and that's stock-based compensation. That dilution is a real impact on share owners and the percentage of the company that we own, but it's a positive step in the right direction. Free cash flow margin, 3.2% positive free cash flow. This is massive. Again, it's cash flow, so it doesn't include non-cash expenses like stock-based compensation. The point is that the company now has reached a point it doesn't need the capital markets to raise money. It can self-fund the business. Of course, the balance sheet's very strong. As you see, $1.9 billion in cash, a substantial net cash position, meaning that even if we do see periods where they spend more money than the operations generate in cash flow, things like making acquisitions, deciding to spend some capital to expand the base of the business's infrastructure, things like that, they have the capacity to do. And the business is steady state cash flow positive now. That is a wonderful step in the right direction. Let's talk about customer growth. This is the key that is driving the whole thing. And a couple things that are important to note here. So number one, customer growth was only 9% in the quarter. Now, that might seem concerning. If customers are only growing 9%, a couple things are happening. This is a bit of a land and expand business model. A lot of customers will sign up with Confluent for a department or a specific application, a specific use case. And then over time, they expand their use of Confluent. So that's why you see these numbers here, $100,000 a year ARR, which is annualized recurring revenue, growing at 21%. And then the big 1 million plus ARR customers growing even faster, 24%. Customers spending $5 million a year in ARR more than doubled from 9 to 19 year over year. It's seeing customers sign up and start spending more money and increase their use of Confluent across their Kafka and their data streaming needs in their organization. And we see more evidence that this is happening based on their dollar-based net retention rate. So the gross retention rate is above 90%. So this is a churn number. So this does tell us that somewhere around 10% of their customer base does churn, which is not super high, but it's not super low either when we see other SaaS companies that it's in the mid 90s, but it's a healthy number. And dollar-based net retention rate slightly above 125%. What does that mean? It's like comps. If you're a retailer, it means that for every dollar you brought in last year from a customer, you're bringing in $1.25 this year. So again, that's the expand part of that land and expand model. Lastly, let's talk about guidance. The company is doing something a little different. They're going to start guiding to subscription revenue, and they're doing that just on the quarterly basis. If you take a look at their actual guidance, they're being pretty conservative here. We see for the full year, 22% growth, anticipating revenue to come in, getting really close to that $1 billion a year mark. And in the first quarter of the year, anticipating growth roughly in line with the full year, subscription revenue, 24 to 25%. Again, that's less than that 30% growth that we saw last year, but they're anticipating it being healthy growth. Going to be a little bit negative in the operating margin in the first quarter, but for the full year, expecting to be operating margin break even and to earn about 17 cents a share on an adjusted basis. Here's one I really want to highlight because this talks about the company's ability to self-fund its operation, and that's free cash flow margin, expecting to be break even in 2024. That is a real positive. Company's been talking about that for a while, so that is really, really good to see. Okay, put it all together. It's a good result. Came in better than Wall Street analysts were expecting. Answered some questions about some big customers where they were seeing some churn, and there were thoughts that that was really going to upend the business, and maybe this great story that we saw wasn't going to pan out. But they're really saying, you know what? Look, we're growing well. We're growing at a steady state, and we're growing profitably at this point. So if you put it all together, I think that's pretty compelling thinking about the state of the business. Now let's think about the state of the stock. Is this a business worth buying today? Okay, what's it worth on a share basis? $31.65. We don't want to anchor too much on prior prices and how much the price has moved up today, but it is worth noting that from the IPO, the price, the first day of trading, the stock is still down about 30%, even though, and it's had a bit of a bumpy ride, the stock has made some really good gains over the past year. But none of those questions really answer whether or not the stock is a buy. So what I'm going to do here is I'm going to put in market cap because I want to just start there. This business is about $10 billion in market cap. Call it $9.7 billion. We saw the guidance is for about $950 million in sales in 2024. So that means it trades for roughly 10 times 2024 sales. For context, a lot of the best software companies in the world trade for similar sales-based multiples. Now, that's empty calories, though, when we think about sales. But I will say it's a starting point because we're seeing the company get to cash flow break even. And when we see companies that trade for 10 times sales that are generating high 70s to low 80% gross margins. And once they get to higher scale, they become absolutely cash cows. And the cash flow multiples that you start to see can be really, really appealing. The company has substantially de-risked itself over the past couple of quarters. We're seeing it get to a steady state where we know it can live within its own cash flows, and the stock price looks to be relatively reasonable based on that $60 billion plus addressable market that they say is going to be $100 billion within the next few years. The fact that it's not even a $10 billion business at recent market cap valuations, the growth rates, and the kind of profitability it can generate at scale.